Thank you for everyone for not booing about going to Cal. I appreciate that. I was wondering whether Dean Olian would bring up my academic career. So it's great to be here in Los Angeles. Great to be here at this event. It's great to hear the views of my colleagues around the forecast for the U.S. and this region. It allows me to talk without showing lots of numbers and facts and figures and charts, and I think give maybe a bigger, broader overview of how I see the economy and where I see policy going. Now, one of the things I'll start with is that one of the pleasures of being a president of a Federal Reserve Bank, especially the 12th District, which represents the 9 western states, is for a kid who grew up in Sacramento who studied economics, this is probably as close as I'll ever get to the entertainment industry. But I will also mention, in recent weeks and reading all the news about the Fed's actions or lack thereof, I realize that I actually do share something with Hollywood, and that is that everyone's a critic. So my comments today really be about the economic outlook, how I see it, where I see monetary policy, what we did or didn't do, where I see it going, general how I see the economy going. Now, it's important whenever a Fed speaker like myself addresses an audience like this, I am, of course, expressing my own views and not necessarily those, not shared necessarily by those of my colleagues. Now, I don't think I have to give out a spoiler alert before I mention that the Federal Open Market Committee in our last meeting decided to hold off on raising interest rates. In my view, that was a close call. As the Dean mentioned, I'm a voting member of the FOMC. So I viewed it as a close call, and it reflected the conflicting signals we're getting today. On the U.S. side, the U.S. economy side, the economy continues to strengthen. In fact, we're very close to full employment, something I'm going to talk about a little bit in this talk. But of course, international developments do pose some significant downside risks. And our policy deliberations and decisions basically have to carefully weigh the various factors and come to a best judgment that we can. So let me start with some of the good news. And what I think is unequivocally good news, and we saw that in some of the presentations already, is the U.S. economy, I'm talking about the entire U.S., is entering the 7th year of the expansion with actually quite a bit of solid momentum. Growth over the last 5 years, just take that period for example, GDP growth has averaged above 2%. The unemployment rate has come down by nearly 1 percentage point per year on average during these 5 years. And I see, based on what we're seeing today in the data, based on the momentum we have, I see that pace of improvement continuing, despite what are significant global risks and global headwinds. Now, one of the big drivers of the U.S. economy today, like always, is the consumer. Consumer spending, real consumer spending has increased over 3% over the past year. And auto sales, which Jerry talked about, are on pace to reach 17 million units vehicles this year, which would be the highest number we've seen since the early 2000s. When looking at the fundamentals, I think behind consumer spending, I think that they're actually quite strong, and they should fuel continued solid growth in consumer spending. Let me just name highlight a few factors I think are very positive for growth. One is, despite the declines in the stock market recently, wealth to income ratios are actually quite high and near all-time highs. Household debt has come down considerably over the last several years. So household balance sheets, both sides of the balance sheets, are actually in very good shape. And the real incomes have been growing quite strongly, in part because of the decline in energy prices and the very low inflation. So all three of those, I think, come together to indicate that consumer spending should continue to be an important driver for the economy. Another part of the economy that's doing well is business spending, business investments on an upswing as well. So here's my forecast for GDP, and it's interesting to compare how other different people view this. My forecast is that real GDP will average about 2.25% in the second half of this year, and then be a little bit above 2% next year. Now this is so I'm going to explain where my baseline is. My baseline view is the potential growth is around 2%. So even with these numbers of 2.25, a little above 2, that's still an economy that's outpacing its potential. Now with that comes an improving labor market, and actually there the news has been really quite encouraging. We're on pace this year to add about 2.5 million jobs in the U.S. economy. Job vacancies are at the highest rate that we've seen since they first started collecting this data back in 2000. In my view, given the progress we've already made and the momentum we still have going right now, we should get to what I think of as a full employment on a broad set of measures of the labor market, either by later this year or early next year at the latest. Now, my forecast for the unemployment rate is that, which is currently 5.1%, is that going to continue to edge down over coming months, falling below 5% at the end of this year, and falling and staying below 5% through 2016. So that really brings you to the question of what does we made a lot of progress. We're now unemployment rate about 5.1%. So what does it mean to have a healthy, full employment economy? What does that actually look like today? And importantly, has that changed after the events of the financial crisis and the recession? So for economists, the metric that we typically use is something called the natural rate of unemployment. And that's the unemployment rate that we think is optimal in a highly functioning, healthy economy. So economists, when they're asked about what's the natural rate of unemployment, before the recession, they would have put a typical answer would be about 5%. During the recession and recovery, there's been a lot of research by economists, both in the Federal Reserve System, but also academics, basically asking, has that changed? Is there a new normal around the labor market? And some have argued that perhaps the natural rate of unemployment has risen because perhaps increasing skills mismatch between the jobs and the workers. And others have argued that perhaps the natural rate of unemployment has come down, partly because of the demographic composition of the workforce has tended to move us to having a higher share of groups that tend to have lower unemployment rates. So there's been a lot of research on this, and again, I've been following this very closely. My own assessment, and when you net out all the different effects and the results from this analysis, is that the natural rate of unemployment really isn't that different than it was before. In other words, there haven't on net been any factors that have had a lasting and significant effect to push the natural rate up or down. So basically, the new normal is the old normal, and my own estimate of the natural rate of unemployment is 5% today. So thinking about where the unemployment rate is, it's 5.1%. Obviously, we're very close to that objective. Now, in thinking about turning to inflation, which is another one of the dual objectives of the Federal Reserve, that has been running lower than I would like to see. I tend to look at a measure that's called the trim mean measure of the inflation rate, which takes out the more volatile components, and that's been running pretty stable at a little bit above 1.5% over the last year or so. So that's below the 2% goal that the Federal Reserve wants to see in the medium term. So the natural question you could ask is, wait a minute, if the economy is at full strength, if we're back to full employment, why is inflation remaining so low? And I think to answer that question, you do have to look beyond our shores. You have to look at abroad at the influences on inflation from other countries. And specifically, the oil prices have dropped dramatically. The dollar has appreciated markedly in the last year. That's pushed down import prices. They're actually, the price of imported goods and services is falling, and that's pushing down our inflation rate. Now, past experience teaches us that those are large effects in inflation, but they tend to be transitory. So assuming the oil prices and the dollar more or less stabilize going forward, those effects in the inflation rate should dissipate. And in addition, with those effects dissipating, and with the economy strengthening, I expect inflation over the next couple of years to move back to our 2% target. Now, in this forecast, there are obviously, like any forecast, there are upside risks and downside risks. I'll highlight some of the upside risks because I think they've already been brought up this morning. I do think they're relevant. One is housing could actually rebound more strongly than I built into my forecast. Housing and construction, as we saw earlier, has been relatively weak, and that could rebound more strongly. Also, consumer spending actually hasn't shown the surge that you might have expected with the low gas prices, and it could be that consumers, as gas prices, oil prices stay low, they'll start changing their behavior, maybe more willing to spend that money. So those are two of the upside potentials for our economic growth. Of course, there's some downside risks, and I generally see these as coming from abroad. One is you could have a further slowdown or spillovers from foreign countries, their economies weakening, or a further appreciation of the dollar. So in thinking about monetary policy, obviously all these domestic considerations or developments and the international developments have implications for how we approach the monetary policy decisions. And the way I would think the best way to understand the decision-making process is to think about how that we're balancing various considerations at the time, some of which would argue for us having greater patience or a little bit more patience before we start raising rates, and other considerations that would lead one to want to start the process of raising rates sooner rather than later. So again, the monetary policy decisions have to reflect a careful weighing of these different considerations, merits, the risks of these, and come to a decision from that. Let me give a brief discussion of what the main arguments for patience are, greater patience. So let's hold off on raising rates. The first and foremost to me is what's called the zero lower bound on interest rates. And that's the fact that it's hard to lower interest rates much below zero, and that creates an asymmetry in the ability of monetary policy to respond to shocks. So for example, if the economy were to weaken or inflation were to fall further, we couldn't lower interest rates given that they're already close to zero today. We really don't have a lot of power to lower interest rates to stimulate the economy. On the other hand, if we were to delay raising rates, the economy were to pick up and growth were to lift off, or we would see inflation move up, of course then we would be able to raise interest rates. There's no constraint on that in response. So that asymmetry is an argument for being a little bit more patient than otherwise. And of course it does bring up the issues of the risks to the outlook. And those risks I think are really well exemplified by events around the world over the last year. We've seen slowdowns in countries and from China to Brazil to Europe, around the globe. Those countries, as their economies have slowed, as they've had the policy responses to those slowdowns, that's affected our exports. It's also affected the value of the dollar, pushing up the value of the dollar, which slows U.S. growth and pushes inflation down. So clearly a risk for the outlook is that we could get some more bad news about global developments, and those would add to those effects. The third I would mention is that inflation has been running below our 2% target for over 3 years now. And this is not just unique to the United States, it's a global phenomenon, low inflation around the world. Importantly, the U.S., we do have the ability to control the inflation rate ultimately, but in the near term, developments around the world, the slowdowns I mentioned, the fact that the dollar has strengthened clearly has had a significant effect in pushing down inflation. And so when you think about my forecast, I see those effects dissipating and inflation rebounding to 2%. But clearly there is a risk that that forecast won't come true, that in fact inflation will take longer to get back to 2%. And some have argued, given that inflation has been running so persistently low, given that we're missing our target for so long, there's really no pressing need to start raising interest rates. So I think I see those are the three of the main arguments for patience, the reason we've been holding back on raising rates. On the other side of the ledger, I think there are important considerations that suggest that maybe the time is coming to raise interest rates. And I'll start with the lesson on economists all learned from Milton Friedman, and that is a monetary policy has long and variable lags. And I like to use a car analogy, driving a car as a way to explain this. If you're approaching an intersection with a red light, you first take your foot off the gas as you get near the intersection to prepare to put on the brakes if needed. If you don't do that, as you get to the intersection, you're going to have to slam on your brakes, potentially sliding right through the intersection. Now, tied to that is that a policy action that we're starting to raise interest rates a little sooner rather than later would also mean that we could have a more gradual or smooth movement of interest rates up over time, and have more optionality to adjust the path of interest rates to changing economic circumstances. If the economy does better or worse than we want, we can adjust the path of interest rates easily. In contrast, if we wait too long, we would get behind the curve, would need to raise rates and hike rates in a more abrupt fashion. That would reduce some of the ability to maneuver or adjust the policy, and that could also roil markets and have other unintended consequences. Now finally, I would mention that experience experience teaches us that if you allow an economy, no matter how good it feels at the time, to run at a high-pressure economy, running beyond its potential for too long of a time, that eventually imbalances will develop. Sometimes they manifest themselves as excess inflation, sometimes as other imbalances that eventually will correct and lead to a recession. So in my career in the Fed, obviously two of these experiences are very much seared in my memory. Going back to the late 90s, when the euphoria over what was then called the new economy and the dot-com bubble, the huge investment in overinvestment in high-tech equipment. Of course, we lived through a different but related experience in the early 2000s, where the economy became increasingly reliant on irrational exuberance around housing. House prices far exceeded fundamentals, and we had massive overbuilding there. So in both cases, an economy that ran very strong for a very long time became increasingly reliant on unsustainable aspects of the economy, and those fantasies eventually burst at great cost to the economy. Now, in saying this, I want to be clear that I'm not trying to fight the last war in reliving the housing bubble and thinking that that's the problem that we're always going to face. It's really more of a general point about if the economy is allowed to run, if you will, hot or in a high-pressure state for too long, that eventually people will more likely to make decisions that are based on excessive optimism, maybe unrealistic assumptions, as opposed to founded in good basic economics. And that's always possible. Bob Shiller has taught us that there have been bubbles throughout history, but I do think it's more likely or more of a risk when the economy is running in an unsustainable way. In that regard, I am seeing some signs of imbalances today, especially around asset prices, and especially in real estate. We talked about that already. And in seeing these signs, it does trip the alert system for me. One of the lessons from the past, from my own experience, is that if we allow the imbalances to grow too far, to get too large, then the options of how to deal with those or manage those become very limited. I go back to the mid-2000s, where the Fed, we were confronted with a housing bubble or a housing boom that was well underway, and you could debate the decision: should you raise interest rates and possibly risk pricking the bubble and causing the economy to come down, or do you just let's see where this takes us and then clean up afterwards? Now, I'm not going to focus on what's the right or wrong answer or the merits of the various cases, but the lesson I took away personally was by 2005 or so, there were no good choices. No matter what options you're thinking about, whether you're using monetary policy or other policies, by then it's just too late, and anything you try to do to deal with the situation is going to end up with a bad outcome. So what you need to do is you need to take into consideration these risks much earlier when they're more manageable. In that regard, I do note, or am conscious of the fact that house price to rent ratios today in the United States are roughly where they were in 2003, which is quite elevated. And in that regard, I don't see this as being and also house prices continue to rise rapidly, even though they are quite elevated. Now, I'm not saying that we're at some tipping point or a bubble, but I am looking at the path the economy's on, the path that our financial markets are on, and looking for potential potholes on that road. Now, in weighing these different considerations for greater patience, for sooner rather than later, in the past I've been a strong supporter of the view that the arguments for patience clearly outweighed those for arguments for raising interest rates. As the economy has closed in on full employment, the other side has gained greater weight. And I think we're in a closer balance because of that. Looking forward, my own forecast is we'll reach full employment in the near future. I see that inflation will move, in my forecast, back to 2% in the next couple years. So it just makes sense that we would start the process of gradually moving away some of the accommodation that we put in place that got us, some of the accommodation we put in years ago. We actually started that process when we ended the QE3 asset program, and I think the next appropriate step is to start the process of raising interest rates, in my view, likely later this year. That view is not immutable. Of course, it can change depending on economic conditions changes. Now, in thinking about what economy that's getting back to full strength, I think it's important to really be realistic about what normal economic growth and economic improvements will start to look like. During the recession, when unemployment was 10% and the economy was really struggling to get its feet back, we really did need fast growth. We did need a lot of job growth. We needed the unemployment rate to come down sharply. But now that we're closer to full employment, it's actually, we don't need to make so much progress in terms of job gains, in terms of growth. We actually need to see that to slow somewhat, which is what we've been seeing in the data. Now, for example, say in a year from now, when the economy is at full strength, our economy really needs no more than about 100,000 jobs a month to keep up with labor force growth. That's a new normal, and that's something that we would like to see. I still want to see the economy improve, but in the future, that's going to be a normal growth rate for jobs, not the kind of 200 to 250,000 we've been seeing. If we were to keep growing at the pace that we've been growing over the last year in terms of GDP growth, in terms of job growth, in terms of declines in unemployment, we would significantly overshoot the mark. So what I've been seeing is some slowing in the improvement in the economy, some slowing in the labor market growth improvements. I still want to see further improvement, but actually it's desirable to see us see that process slow down some in the future. Now, overall, I see the U.S. economy being on very solid footing. It has on a very good trajectory. There are risks out there. There are always risks. This does remind me of a comment made by then British Prime Minister Harold Macmillan. They asked him what keeps him, what's he worry about? And he said, events, dear boy, events. And that's always going to be true. But things I think are looking up. Things are getting better. And given the improvement we've seen, I think this year will be the time for us to, at the Fed, in my view, to start the process of policy and normalization. Thank you. So if I have time, I'm happy to take any questions from the audience. There are microphones in the center aisle. Just step up to the microphone if I could ask you.
Could you talk about tremendous deficit that we're running right now? Trillions of dollars of deficit.
The U.S. Treasury,
Yes.
the U.S. government deficit.
And what the future is dictating when we're running so fast and loose.
So the question was about the large federal deficits, which are currently occurring even though the U.S. economy is back to full strength. So this is an issue that existed before the recession. It existed, was known about 15 years ago, 10 years ago, 5 years ago. So clearly the U.S. Fiscal situation, it's not controversial, is in an unsustainable position for the long term. This is something the Congressional Budget Office has said, economists of all stripes have said. The real issue is how do you get this back on the right trajectory? The biggest issues going forward really are the Medicare funding and then Social Security. Because those are long-term programs that spend more than the revenue. So to my mind right now, this is not a problem for the U.S. economy in the sense that it's not, interest rates are low, it's not having the effects. But obviously in the long run, we need to get our fiscal house in order. This is understood. And I go back to when I was at the Council of Economic Advisors in 2000, when we were running surpluses, also the longest expansion of all time, I'll brag. So I'm an optimist. I'm from California, so the sun's always shining and everything's looking good. Cal's even like undefeated. It's unbelievable. So I do think that this is a longer run issue that needs to be addressed. That's all I'll say.
I have a question on two strands of looking at policy. The first would be the zero rate policy was put in at the end of 2008 when there's an 8-alarm fire going on in the economy, and that fire has been largely put out. So if you close your eyes and hear 3.9% growth, 5.1% unemployment, inflation at 1.3 on your PCE, but likely to go higher, and you close your eyes, what's the correct Fed funds rate? It would be above zero.
Right.
The counter argument on the policy side would be there's very little experience in going from a zero rate extraordinary monetary policy to normalizing policy. And in some cases, the results weren't all that good in the case of the European Central Bank, in the case of Japan. So therefore, you have to look at the risk of going from a zero extraordinary monetary policy to normalization. So how do you sort of weigh these two things, where one would say keep zero forever, and the other would say is we got to get to 1.5% to 2% pretty quickly?
Right. So, these are exactly the kinds of considerations that we are grappling with. Clearly, the history of other countries trying to raise rates has not ended up going, not sticking, if you will. I think that the important thing is that our monetary policy decisions have to be driven by our economic outlook. Like you said, we're basically, 5% unemployment, we're at full employment. Inflation's low, but it's not really that low. Core inflation's running at 1.3. So I think we have to keep an eye on the U.S. economic outlook, evaluate these risks, and also be willing, and I think importantly, willing to take some first steps in terms of raising interest rates. We're only talking about 25 basis point increments. Obviously, those would not have huge implications for the economy, and then reassess those decisions down the road. I've said this many times. If we were to raise rates and we were to hit by a global slowdown, and that would call for lowering interest rates again, then we should lower interest rates again. We should change our mind based on the data. And not worry so much that that we maybe will look like we made a mistake or something. So this is the weighing of this. If you start with a Taylor rule or kind of a standard way of thinking about start of the analysis, where would monetary policy be today? Clearly, we would be well above zero. That's just a starting point. All these other considerations, I think, push you down a little bit. But clearly, as I said, I think it's the weight has now moved towards the economy can handle a rate increase or the start of the process of rate increases.
Thank you.
Thanks. Thank you.
One last question, if I may.
Oh.